Leo, you're looking at Dolphin Cove here in Jamaica. Their results are out, so give us the highlights.
Yeah, so Dolphin Cove came out with earnings May 16. So that's their Q1, ending March 2023. All in all, a good number, good earnings report. So of course, I'm just go back a little bit. You would see where in June 2020, the company had significant losses, about 1 million US, right? So this was because of COVID, right? Which really started to hurt them in that quarter. So, it got a little impact in the March 20 quarter, but then in June 2020, and they really got it, right? The company's basically recovered coming into June 2021, where the company recorded about 1.2 million US in profit. So they recovered there. And then now, fast forward a bit, we're looking at March 2023, where we're seeing 98% basically increase in profits to 1.6 million US, right? So that was a good number. So a bunch of things drove that. One of the things, of course, is more guests coming in, about 21% higher than pre-pandemic. So that's if you go back now all the way to Q1 2019, so that's good for them, right? So if I can share my screen for a bit here, so we can see where the revenue is up for the company, and then we can see where the profits for the company is up significantly from that. Moving on a bit here now, we can see where, looking at some of these major ratios, we can see where the current ratio for the company is improved, the quick ratio, the debt to equity. So basically looking at the company's ability to pay debt, the debt levels is fairly insignificant. So that's a very low ratio, which is good for the solvency of the company. And then you're looking at the financial leverage, which kind of backing up that, given how low it is, close to 1. You can see that, again, most of the company's operations is basically funded by equity, and not really much liabilities there. And a strong operating margin, so that's improved. Net profit margins up, ROEs up, and ROA. So basically, on all these metrics, they're basically firing. Now, when you look on the stocks performance, what you're seeing is up about almost 20% for the year. That's a big outperformance compared to the junior market, and you can see that when the earnings came out around here, and then you can see this the uptick. Well, I'm not sure if it's kind of covered up a bit, but you can see this uptick here. So you can see that there's a positive reaction to that news in the market, which you want to see. Now, you zoom in out a bit here, and you can see that the performance for the company has been strong January performance, and then strong May performance, off of the back of those results, really pushing it. And then moving on here now to look at the overall performance in another way, you can see where the stock is off the recent highs, closer to 30, but still up well off the lows, which is around, closer to $5 and change, and it's at 16. So these lows, of course, during the pandemic period, and you have the sell-off here, low, and then you have this here. Now, again, this chart highlights one of the things that can really drive performance in stuff. So you can see, looking around this level, comparing it here, that's a big increase in a short space of time. So this is one of the things about stocks. But of course, on the flip side, you can see the big sell down here.
Right.
And that's why when I talk about stocks, I always want to advise persons about the risk and the reward trade-off. Okay, you can see this reward looks very nice, but you can see that this fall off does not look so nice. If you bought this thing close to 30 and now it's here, you're not so happy with it. You bought it here and you're here, you're very happy with it. So the thing is, again, just perspective, long-term view, try to understand your risk tolerance, because what you don't want is that when it's up here, you panic sell, and and then, or you buy into the hype up here and then it sells off. So you just want to just understand your risk tolerance and understand what you're getting into. So again, it's all good and well when you get those big gains, but you just have to understand the grind.
Before you move on, Leo, is that fall about consistent with what we've seen for the market in general between 2022, 23?
Yeah, I mean, that would be some of it. That would be some of it. That would be in these numbers. Because what you really saw coming, and most of the sell-off kind of occurred in starting like in August 2019. The market was kind of flattening out then, but then of course with the pandemic you had a sell-off. But some companies have actually recently have hit highs, as in like all-time highs. So that's the reason why I wouldn't say all of it is due to that, but in general there is some what I call it now, repricing in the market. So with the interest rates going up, it reprices how persons look on value. So for example, you are looking at the broader market, right? When interest rates are very low, you could have gotten that regular multiples in the market was in excess of 20 odd times. If you look on the average stock, how many? No, it's much lower. So now we're looking at some 16 times earnings, some 15 times earnings. And sometimes you'll see this decline in terms of pricing despite better performance. Meaning a company might be making, for argument's sake, 20 times or 30% more in profit, but yet the multiple people are willing to pay is less. So, back in the day, they paid 20 times, now they're willing to pay probably like 15 times. And that's just a function of interest rates. And you can look at it from multiple ways. You can look at it in terms of opportunity cost. You can understand interest rates go up. Person say, hey, I'm cool with taking 10, I'm cool with taking 11%. I don't need to chase or take a risk in the stock market for it. And then, so because of that, you have a sell-off. You could look at it another way, which is, a pricing mechanism using the CAPM model. Interest rates go up, that changes how the discount rate is applied to well, this might get a little bit technical, but it changes how you discount cash flows essentially. So anyway you want to look at it, higher interest rates generally lead to lower valuations in the market, which will explain part of the sell-off. Because again, the earnings are spectacular. Matter of fact, the earnings beat pre-COVID, and based on what they did in Q1, if they maintain, granted it's yet to see if they can, but if they maintain this kind of performance, it could easily be on track for a record financial year. Again, it's early because it's Q1, but the Q1 was really strong. And all
that's reflecting what we're seeing in the tourism industry in general.
Yeah,
Tourism
so the tourism
has been doing
industry, they did,
exceptionally well.
yes, and they did some investments to build out some of their attractions and things during the downtime, so that kind of put them now in a better position. Not during the last 12 months. So that put them in a better position now in order to capitalize on it. So there's a lot of things going right for them. Yeah, so that's it. That's basically it.